All right, listen to me very carefully. I need you fully locked in for the next few minutes because what I'm about to show you is not a prediction and it's not some financial theory that people debate on podcasts. This is happening right now, quietly, behind the scenes. And if you blink, you're going to miss the early warning signs, the same way most people missed them in 2008. Because this time, the danger isn't coming from the stock market. It's coming from the plumbing, the hidden system that keeps the entire financial world alive. And that system is cracking. I'm talking about the shadow banking system, a part of the financial world that most people don't even know exists, but it controls an insane amount of global credit. And in the last 72 hours, we've seen stress signals flash that we haven't seen at these levels since March 2020. And before that, September 2008. Let me say that again. The exact same kind of liquidity stress indicators that show up right before the world realizes the system is breaking are showing up again, right now. And the scary part? This is not the kind of crisis that starts with chaos in the streets. This is the kind of crisis that starts with silence, with small spikes, with technical issues, with sudden tightening, with funding markets acting strange. And by the time the headlines catch up, the smart money is already out. The exits are already crowded, and the opportunity is gone. So here's what I'm going to do for you in this video. By the end of this, you'll understand exactly what shadow banks are, why their collapse would make 2008 look like a warning shot, and most importantly, the 3 asymmetric moves you can position into right now while the window is still open. This is not fear. This is pattern recognition. This is history repeating, and it's about being early, not being loud. So turn off the distractions, and let's break down the most important financial story that nobody is talking about. Because once you see it, you can't unsee it. Now, before we get into what's happening today, I need to give you a simple framework. Most people think the financial system is basically banks, stock markets, and maybe a few hedge funds. But that's not reality. Reality is this. Over 50% of all lending and credit creation in the developed world happens outside the traditional banking system. Not inside banks, outside them, in a parallel universe. And that parallel universe is called shadow banking. Now don't let the name fool you. This isn't some conspiracy. It's just a system of institutions that behave like banks, without being regulated like banks. That includes money market funds, hedge funds, private equity, insurance companies, pension funds, and a huge network of special purpose vehicles and off-balance sheet entities. These institutions create credit. They borrow. They lend. They use leverage. They fund long-term assets. And they do it with the same risk profile as banks, but without the same safety rules. And this is where the danger starts. Traditional banks have guardrails. They have capital requirements. They have stress tests. They have deposit insurance. And in a crisis, they have the Federal Reserve. They can access emergency liquidity. Shadow banks? They have none of that. They run on leverage. And not small leverage, massive leverage, often 20 to 1, sometimes even higher. And they fund themselves using short-term markets. Markets that can freeze instantly, which means they're basically living on borrowed time. Every single day. Because the shadow banking system is not built like a fortress. It's built like a stack of glass plates. And as long as liquidity keeps flowing, everything looks stable. But the moment confidence cracks, the moment funding dries up, the moment counterparties refuse to lend overnight, the whole structure collapses in days, not months, days. Now here's the number that should make you sit up straight. The Financial Stability Board estimates that the global shadow banking system holds over $200 trillion in assets. $200 trillion. To put that into perspective, that's more than twice the size of global GDP. And most of it is funded through short-term debt that has to be rolled over constantly. Meaning, this entire machine survives only as long as lenders keep saying yes every morning. The moment they say no, the machine stops. Now here's the core thesis of this video. We are watching early-stage liquidity stress appear inside the shadow banking system. And it's being driven by 3 forces. Rising real interest rates, a global debt load that cannot be serviced at today's borrowing costs, and a regulatory system that is still built to fight the last crisis, not the next one. And when this stress grows, it moves in phases. Phase 1 is quiet deleveraging. That's where institutions reduce risk without making noise. They sell quietly. They tighten. They hoard cash. They unwind. And they do everything possible to avoid headlines. Phase 2 is forced liquidation. That's when the selling becomes visible. Assets start dropping. Credit spreads widen. Funds face redemptions. And price discovery breaks. Phase 3 is systemic contagion. That's where the traditional banking system gets pulled into the vortex. Because it's connected to shadow banks through repo, derivatives, prime brokerage, and direct lending. And right now, we're in phase 1, the early phase. The phase where the average investor still thinks everything is fine because the stock market hasn't collapsed. But the stress is visible, if you know where to look. And that's exactly what we're going to do. But before that, I need to take you back to 2 historical moments. Because what's happening today isn't new. It's a script, and it's been run before. Twice. And both times it ended in massive wealth destruction for the unprepared, and generational wealth creation for the ones who saw it early. The first parallel is 1929 to 1933. The Great Depression. Everyone remembers the stock market crash. But the real devastation didn't come from the crash itself. It came from the collapse of the shadow banking system of that era. Back then, most lending wasn't done by traditional banks. It was done by investment trusts, holding companies, broker-dealers, all operating with extreme leverage. They borrowed short-term money to fund long-term investments, stocks, real estate, corporate bonds. And when the market crashed in 1929, their collateral collapsed, but their debt stayed the same. Lenders refused to roll over funding. Margin calls exploded, and within months, hundreds of these shadow institutions disappeared. And then the contagion spread. Traditional banks had lent money into that system. So when shadow banks defaulted, banks took losses, then bank runs started, then failures cascaded. Between 1930 and 1933, over 9,000 banks failed in the United States. The money supply contracted by 30%. That wasn't just a market crash. That was a collapse of the credit mechanism itself. And here's the key insight. The people who preserved wealth weren't the ones who held and hoped. They were the ones who moved into hard assets early. Before the collapse became obvious, they exited financial assets and positioned into things that survived systemic stress. Gold, farmland, distressed real assets. And when gold was revalued in 1934, they gained purchasing power, while everyone else was wiped out. Now the second parallel, 2007 to 2008, the first modern shadow banking collapse. In the years leading up to 2008, the financial world created a massive shadow banking apparatus, built on mortgage-backed securities, CDOs, structured investment vehicles, and off-balance sheet entities. These institutions borrowed short-term, in repo markets and commercial paper markets, to fund long-term illiquid assets like subprime mortgages. The leverage was insane, often 30 to 1, and the entire structure was built on one assumption. Housing prices would never fall nationwide. When that assumption broke, the system started cracking quietly. First it was hedge funds, then it was Northern Rock, then it was Bear Stearns, and then, September 2008, Lehman collapsed, repo froze, funding disappeared, money market funds broke the buck, commercial paper seized, and suddenly, the world realized something terrifying. This wasn't just a banking crisis. This was a shadow banking crisis that dragged traditional banks into the abyss. The Fed had to invent new lending facilities on the spot, just to stop the system from imploding. And even with all of that, global credit markets froze for months. Now here's the lesson from 2008 that applies directly to today. The collapse didn't start with a headline. It started with quiet stress in funding markets. Repo rates spiked. Commercial paper slowed. Money market funds saw outflows. Those were the early warnings. And they showed up months before mainstream media admitted anything was wrong. The people who acted early moved to cash, moved to gold, positioned for volatility, survived, and then they bought generational opportunities when everyone else was panicking. The people who ignored it, who trusted the narrative, who stayed fully exposed, watched half their wealth evaporate. Now, let's bring this into the present moment, because the parallels are not subtle anymore. They're screaming. The overnight repo market is the plumbing of the financial system. It's where banks, hedge funds, and institutions borrow cash for 24 hours, using securities as collateral. In a healthy market, repo rates trade close to the Federal Reserve's policy rate. Very close. But in the last 72 hours, repo rates spiked. And not just a little. They spiked in a way that tells us something critical. Some institutions are willing to pay a premium just to access overnight cash. And that only happens when normal funding channels start breaking. This is the exact pattern we saw in September 2019, when repo markets briefly seized, and the Fed had to intervene. It's the same pattern we saw in March 2020, when the entire system almost entered a full liquidity collapse. And at the same time, money market fund outflows have accelerated. In just the past couple weeks, over $150 billion has been pulled out. Now think about that. Money market funds are supposed to be the safest place on earth. So why are investors pulling out? There are only two reasons. Either they desperately need cash, because they're under stress themselves, or they're losing confidence and moving into even safer alternatives like direct treasury bills. Either way, that's not normal. That's a warning, because money market funds are a major source of short-term funding for corporations and financial institutions. When money flows out, credit tightens, the supply of lending shrinks, and that pressure hits everything. And then there's commercial paper. This is where it gets ugly. Commercial paper is short-term unsecured debt. Corporations use it to fund payroll, inventory, daily operations. It's supposed to be liquid, low risk. But recently, issuance has dropped sharply. The amount outstanding has fallen by tens of billions, and spreads have widened, meaning investors are demanding higher rates, even for lending for just 30 days. And when investors start demanding higher compensation for short-term lending, it means confidence is breaking. And when confidence breaks in commercial paper, corporations suddenly face a cash crunch. And when corporations face a cash crunch, the economy follows. Now, why is all this happening? Because the root cause is the same as 1929 and 2008. Excess leverage, built during cheap money, colliding with a higher rate world, where that leverage becomes unsustainable. For over a decade after 2008, rates were basically zero. Central banks flooded the system with liquidity. Quantitative easing suppressed yields. And in that environment, leverage wasn't just profitable, it was almost required. Borrow at 1%. Invest in anything yielding 4%. Collect the spread. Repeat. So hedge funds did it. Private equity did it. Insurance companies did it. Corporate treasuries did it. And the shadow banking system expanded like a balloon. But then 2022 happened. Rates exploded upward. Fastest tightening cycle in modern history. And now, all that leverage built at zero has to survive at 5%. That's not a small adjustment. That's a death sentence. Because the cost of rolling over debt has multiplied. Institutions can't earn enough on assets to cover liabilities. So when their short-term funding matures, they have two choices: refinance at painful rates or liquidate assets. And that is phase one, quiet deleveraging, happening right now. Hedge funds cutting risk, private equity trapped in frozen exits, pensions realizing mismatches, insurance companies feeling pressure. And this creates selling pressure across markets, which pushes asset prices down, which worsens leverage, which forces more selling. A feedback loop. But there's a second layer, and this is what makes shadow banking collapses so violent. The system is built on collateral rehypothecation. Let me make this simple. In repo markets, you borrow money and post collateral. The lender takes that collateral and uses it to borrow again. And the next party uses it again and again. The same collateral gets reused multiple times. So the system is basically running on the same asset being counted again and again. It works during calm periods, but in stress, it breaks instantly because if one link fails, the entire chain collapses. That's what happened with Lehman. Collateral got trapped in bankruptcy. Counterparties realized they weren't secured anymore, and panic spread like fire. Right now, we're seeing early signs that collateral chains are tightening. Institutions are being forced to post more and higher quality collateral to borrow the same amount of money. That's not strength. That's lenders getting nervous. And once lenders get nervous, it becomes self-reinforcing. More margin calls, more collateral demands, less liquidity, more stress. Now, add derivatives. The BS has reported global notional derivatives exposure above $600 trillion. Interest rate swaps, credit default swaps, currency forwards. These contracts assume counterparties survive. But in a shadow banking collapse, counterparty risk explodes. And if one major player goes down, the exposure cascades, just like AIG in 2008. And there's one more factor that makes today more dangerous than 2008. Concentration. After 2008, regulators forced consolidation. Small banks got absorbed. Big banks got bigger. Today, a handful of institutions hold a massive percentage of U.S. banking assets, and they are deeply embedded in shadow banking through prime brokerage, asset management, and trading. If stress forces one of them into trouble, there is no clean resolution. The failure would freeze global credit markets instantly. So what will the Fed do? Exactly what it always does. When forced to choose between deflationary collapse or inflating the system, they choose inflation every time. And that brings us to the real question. How do you position for this? Not emotionally, not with panic, with asymmetric logic. Because in moments like this, the goal isn't to predict perfectly. The goal is to survive the volatility, protect purchasing power, and be liquid enough to buy assets when they get dumped. So here are the 3 asymmetric plays. The first is short-duration U.S. Treasury bills. I know it sounds boring, but in a funding crisis, liquidity is king, and T-bills are the collateral of last resort. They're what the Fed accepts. They're what institutions run to. They're what everyone wants when the system is stressed. The asymmetry is simple. Your downside is limited, but your upside is survival, optionality, and purchasing power when everything else gets liquidated. And if the Fed cuts rates and restarts QE, bonds rally hard, and you're already positioned. The second is physical gold and silver. Not paper claims, not ETFs, physical. Because in a shadow banking crisis, the credibility of the entire financial system gets questioned. And when credibility breaks, people run to assets with zero counterparty risk. Gold and silver have survived every currency experiment in history. They cannot be printed. They cannot be rehypothecated. They cannot be frozen by a brokerage. They cannot disappear in bankruptcy. In 2008, gold exploded upward after the Fed response. Not because gold changed, but because trust in the system collapsed. And today, the debt is higher, the leverage is larger, and central banks have fewer tools. If you don't have at least a meaningful allocation to physical metals stored outside the banking system, you're taking systemic risk without being paid for it. The third is volatility positioning. Options. Tail risk hedges. Because when phase 2 begins, forced liquidations make volatility explode. The VIX doesn't rise slowly. It gaps. In 2008, it hit 80. In 2020, it hit 85. And the key is this. Insurance is cheap before the fire. Once the fire starts, it becomes unaffordable. So if you understand options, out of the money puts, spreads, tail hedges, these can turn a small premium into massive protection. And more importantly, dry powder. Now, what do you do immediately? Here's the checklist. First, assess exposure. If you're holding high-yield bond funds, Leveraged loan funds. Structured credit. You're directly exposed. These vehicles rely on liquidity, and liquidity disappears first. Second, check where your cash is. If your money market fund holds commercial paper or risky repo agreements, you have exposure. Move into government-only funds or direct T-bills. Third, establish physical precious metals. This isn't a trade. It's insurance. Fourth, reduce leverage. If you're using margin, dial it back. Because in forced liquidation, even good assets get sold at terrible prices. Fifth, if you understand options, build volatility hedges now, not later, because later is too late. Now I want to ask you something, and I want real answers in the comments. Do you think the stress we're seeing right now is a temporary blip, something central banks can smooth over? Or do you believe this is the early stage of a systemic event that escalates in the coming months? Tell me what you think. Tell me what you're doing. Because the smartest communities aren't the ones that agree. They're the ones that think. And if this video gave you clarity, here's what I need you to do right now. Subscribe and turn on notifications. Because the mainstream financial media will be 6 months late to this story. And by the time they start covering it, the opportunity is gone. Share this video with anyone you know who has money inside the system and thinks it's automatically safe. Because the people who get hurt the most are the ones who trust the system blindly and don't realize the rules changed until their money is locked, their fund gates redemptions, or their liquidity disappears. This is not about panic. This is about pattern recognition. The shadow banking system is under stress. Funding markets are cracking. Liquidity mechanisms are weakening. And Wall Street is quiet because they need time to unwind. Smart money is already moving. The only question is, are you going to move early or wait until the herd realizes? Because when the herd realizes, it's already over. I'll see you in the next one. Stay sharp, stay liquid, and stay ahead of the curve.